So, all right, everyone. My name is Yasiryamin. Bismillahirrahmanirrahim. My name is Yasiryamin, and I welcome you all in this session. Now, guys, in today's session, we are going to attempt another past paper question, and this past paper question is from your last examination attempt. It is from June 2024. And what we are trying to do is we are trying to attempt a section B question. This is question number 3 of ACCA's June 2024 SBR attempt. This is a very good question. It will test, various concepts that you must have learned throughout your preparation. And it will allow you to have a very good revision of whatever you have learned with regards to the areas that have been examined in this particular question. And it will allow you to challenge yourself and you try that you remember those things which you have learned in the normal class. All right, so it is certainly going to help, and at the same time you will learn how to attempt a particular past paper. So without any further ado, I think let's begin. So it says that Jobon company is the parent company of a clothing retail group. So first of all, you need to understand that Jobon company is within the retail sector. They say that the financial year end is 31st of December 20x7. I have always told my students that whenever you see accounting year ends in a question, please make sure to highlight those. You always need to remember the accounting year end. So in this particular question, your accounting year end is 31st December x7, and that means your accounting year would have started on 1st January 20x6. So this is the particular area of this current financial year that you need to focus on. Examiner says the following exhibits available on left hand side of the screen provide information relevant to the question. Now, there are 3 exhibits that would have been provided to you in your examination. The first exhibit relates to impairment of cash generating units. Impairment of cash generating units. Now, can you guys assess which accounting standard is going to be tested here? Which accounting standard? I mean, it should directly come into your mind which accounting standard predominantly will be examined in exhibit number 1. And I'm very sure that you must have thought about IS 36, impairment of cash generating units. So let us have a recall of what we studied in IS 36. Let us just have a quick recap of whatever we studied in IS 36. So IS 36 was about impairment of assets. And IS 36 told us that impairment is said to arise when your carrying value of asset exceeds your recoverable amount. Now, recoverable amount is the maximum amount of economic benefits that you can obtain from a particular asset. So if the maximum amount of economic benefits that you can achieve from your asset, and if you compare that recoverable amount with the carrying value, and your carrying value is reported higher in your financial statements, then we would say that our assets have been overstated. And if assets are overstated, obviously you need to correct those by understating them, and therefore you recognize an impairment loss on your asset. Recoverable amount on its own is basically higher of two things. One thing is fair value less cost to sell, and the other thing is value in use. I mean, an entity only has 2 options when it wants to determine what would be the maximum amount of economic benefits that can be achieved from an asset. I mean, either you can obtain economic benefits through sale of the asset. You can sell the asset right now, go into the market and sell it. And that's why fair value less cost to sell would be relevant for you. Or otherwise, you can decide to continue to use the asset. And if you decide to continue to use the asset, the value that you derive by using the asset, that value in use would be relevant. So IS 36 says that whatever figure is higher, fair value or value in use, the higher of figure will be considered as recoverable amount. And if carrying value exceeds the recoverable amount, impairment is said to arise. Now, IS 36 did not end here based on just providing you the facts about how impairment testing is performed. IS 36 has also provided you some sort of guidance. And guidance in particular has been provided with regards to the determination of value in use. So do you guys remember what was there under IS 36 regarding value in use? So IS 36 told us that it must be management's best estimate. It must be, value in use must be calculated on the most recent forecast. The forecast period should be 5 years or less, unless a longer period can be justified. And the financing and taxation cash flows may be ignored. Remember that. And when we discussed about CGUs, so examiner IS 36 told us about CGUs as well. These are cash generating units. So cash generating units are basically assets or group of assets, the smallest identifiable group of assets for which there are identifiable cash flows for which recoverable amount can be calculated. You would remember that whenever there is the topic of a cash generating unit, you apply the allocation of impairment according to a set pattern. And the set pattern is that first you allocate the impairment onto a specific asset. Then you allocate impairment on goodwill, and then you allocate impairment on remaining assets on a pro rata basis. So this kind of knowledge you should exactly remember whenever you have just seen the title of exhibit number 1, and which was impairment of cash generating units. This is something which you should have immediately recalled in your head. All right. So examiner says that impairment of cash generating unit exhibit will provide details of an impairment test carried out on CGU. The exhibit number 2 is going to be related to sale of subsidiary, which describes the plan to sell a wholly owned subsidiary. Now, what comes into your mind when you see the word regarding exhibit number 2, sale of subsidiary? Which topic might have been tested in exhibit number 2? I mean, give me your best guess. I mean, your best guess is absolutely right. Disposal of a subsidiary topic would have been tested. And you must have remember, you must remember what types of disposal did we study in our course. There were full disposals, and then there was a disposal in which your subsidiary was converted into a normal equity investment, which was carried under IFRS 9. Sometimes it was a disposal which resulted in an associate, from a subsidiary. And then there were some type of disposals which were called as subsidiary to subsidiary disposals, where effectively there was no significant change in the ownership style, and you still retained control over your investment. Do you guys remember? I mean, these sort of things you should always remember while you are reading the question. Whatever I've just told you, this should be in at the back of your mind. Then the third exhibit will be related to after date events. Can anybody guess what after date events would mean? I mean, this will describe the events after the reporting period which may impact the accounting treatment and presentation of the wholly owned subsidiary. Can anybody tell me which accounting standard would be in question here? Which accounting standard would most likely be tested here? It's about IAS 10. And let me just recall IAS 10 for you guys a bit. You see, IAS 10 was events after the reporting period. So the scope of IAS 10 was that any event that occurs after the reporting date. You see, almost every accounting standard is applicable till the reporting date. Let's say that your reporting date is 31st of December 20x7. So whatever transactions or whatever events that happen during the year, IAS and IFRS are applicable on those. But IAS 10 is the only exceptional accounting standard that only talks about those events which occurred after the reporting date, but till the date financial statements have been authorized for issue. So this is the scope of IAS 10. Events that occurred after the reporting date, but till the date financial statements were authorized for issue to shareholders. Do you guys understand? Now, once you have clarified the scope of IAS 10, then you need to understand whatever events occurred during this time can either be classified as adjusting events or as non-adjusting events. Adjusting events are those type of events for which there is evidence that condition of such events existed at the year end. So even when you were standing at the year end, there were some sort of hints and there were some sort of indication that such an event can occur. If there is an event for which there was indication that such type of an event would occur, and there was the evidence that such type of an event could occur, and the evidence existed at the year end, such type of cases are known as adjusting events. Now, what do you mean by non-adjusting events? Non-adjusting events are all those events. Non-adjusting events are all those events which occurred after the reporting date, but before the financial statements were authorized for issue. But for these type of events, evidence does not suggest that conditions of such an event existed at the year end. So these are type of the events that you do not adjust within the current financial period, and you let them go towards the next financial period. That's the whole logic. And at all times, we studied in IS 10, at all times, any event which creates a going concern threat, any event which creates a going concern threat is always to be treated as an adjusting event, because technically there will be no next financial period. And if there will be no next financial period, it does not make sense to wait for the next financial statement to be issued, because there is going to be none. And that is why going concern threat is always considered to be an adjusting event. Make sense? Now, this is what you could recall in your mind when you would have read the names of the exhibit which were shown to you in your examination. After that, what do you do? After that, I will not suggest you to just start reading the exhibits one by one. I don't think that's a good strategy from a psychological point of view. What I would suggest is that if I were you, I would directly go to the requirement. I would see that, okay, the whole question has been spread onto different parts. There is part A, there is part A, there is part B, and there is part C. And the bifurcation is 9, 8, 8 marks, a total of 25 marks. Now, if I were you, I would only read requirement number 1. I would not read requirement number B and C, because it will only confuse me and it will only pressurize me while I'm attempting my examination. So let's focus on part A for the time being. So part A is related to only exhibit number 1. So we briefly read the requirement of part A, and we read the exhibit 1. That is the correlation, right correlation. So in exhibit number 1, for 9 marks, I want you to promptly answer me if the requirement seems to be difficult or not. I want a prompt answer. Okay, I'm not going to wait. So the first part of the requirement A is you need to explain why the cash generating unit should have been tested for impairment. The question is why something don't be pressurized by the word CGU. Don't be pressurized by the word CGU. It simply asks you explain why impairment testing should have been conducted. Very simple question. Without even reading the exhibit, can you imagine in your mind why would impairment testing for any asset or a group of assets or a CGU would be conducted? Give me a theoretical answer. Explain why. What is the criteria under IS 36 that triggers impairment test? You see, IS 36 does not want you to check for impairment losses every day. For that sake, it does not want you to check for impairment losses every month or every quarter or every year for that sake. IS 36 says that you should test for impairment whenever there is a hint for the same. And hint could be from internal sources and it could be from external sources as well. Internal sources would include, the loss of revenue or the loss of customer or your budgets or your forecast telling you that you're not going to make it, or there is some idle time happening, or there are some damages that you see on your asset. These are some internal hints. And there can be external hints as well. External hints would mean, like, for example, there is a market crash, or there is a recession, or there is an increase in market interest rates, or there is there is rumors, or there is increased compliances, or there is earthquake, a national catastrophe, or something like that. Now these are the type of indicators which motivate you to perform an impairment test. So if I were you, if I or rather I would ask you a question: do you think that first part of requirement number A can be difficult from any sort? Can this be difficult? I mean, whatever the scenario entails, you just need to figure out that if in the scenario there are any hints, there are any internal hints or external hints that encourage you to perform an impairment test. Does does that not make sense? Please let me know. Does that make sense? Is that fine? So I have actually developed an answer before even reading the exhibit. This is the expert level that you should be on. The second part of the requirement would be that you need to discuss whether methods used to calculate the value in use and the discount rate are acceptable. So in the next part, you need to discuss what should be the rules or what should be the logics that should be applied when you're calculating value in use. And you need to discuss about the discount rate as well. And obviously you do that with reference to what is required under IS 36. All right. So now we have made up our mind how we would be approaching on this 9-mark requirement. And now we go on to read the exhibit and make up our answer. All right. So let's read exhibit number 1, which is about impairment of cash generating units. Examiner says that Jobon company is a lessee. Jobon company is a lessee. It leases a number of commercial property which it uses as a retail stores. So basically you are like a retail retail outlet chain. You take stores on leases on different parts of the city or different parts of the country, and you run them, and that is how you make money. Make sense? It says that as a result of an increase in customer online shopping, Jobon company's revenue from these retail stores have halved. Does this line trigger anything to you? Does this line trigger anything to you? Anything that comes into your mind when you read this line? As a result of an increase in online shopping, the sales of these retail outlets have halved. They have actually, dropped down to what they were. They have dropped down to 50% as compared to what they were. Do you think about anything? After you would have read the requirement already, the first thing that should come into your mind while you read this line would be that, sir, this is hint for impairment. This is definitely a hint for impairment. And what would you call it? Is it a hint of impairment from internal sources or external sources? This is certainly an internal hint, right? And you see, internal hints, provide you an objective evidence that impairment would most likely arise. For external hints, you are not always sure if impairment would arise or not. You see, external factors are those factors which are beyond your control. So they are not, apparent that impairment is there for sure. But often internal hints are rock solid. While you see that your revenue has declined by 50%, I mean, it is enough objective evidence that for sure impairment is coming your way. Make sense? Examiner says each retail store is a cash generating unit and comprises of right to use assets, fixtures and fittings, and allocated central assets. So each retail store as an aggregate, each retail store is a cash generating unit. So what your examiner is trying to say is that, you see, there are different retail outlets of Jobon company within the city. And if you look at each retail outlet, in a retail outlet, there is a leased space. So there is some right to use asset. And obviously there would have been a corresponding FLO as well, don't get me wrong. And then there will be some fixtures and fittings in this particular outlet, and there will be some other assets, centrally allocated assets and something like that. So what IS 36 or what Jobon company is trying to tell you is that you are not supposed to run impairment testing on individual assets. They don't want you to run impairment testing on individual assets because each individual asset may not have identifiable cash flows. And that is why what they do is they treat the whole retail outlet as one CGU. And more definitely, every CGU will have multiple assets or liabilities on which you would need to allocate your impairment. Is everybody with me? Does this all make sense to you? Is it clear for everyone? Just give me a yes or a no. Is it clear to everyone? Make sense? Then it says that Jobon company calculated that a total impairment loss of $50 million should have been recognized in relation to the retail stores CGUs. So the good part is that your examiner has already calculated an impairment loss of $50 million. And now you would be thinking, sir, that the only thing that we could do right now, that if the impairment loss has already been calculated, I mean, yeah, our examiner might require us to allocate this impairment, or our examiner might require us to assess if this impairment has been correctly calculated or not. And if you remember the requirement very clearly, your examiner wanted you to discuss effects of the calculation of value in use and discount rates. Make sense? So although the examiner has already calculated this $50 million impairment loss, you should not be too sure about this $50 million figure. Now, this $50 million figure, once we read the whole question, it might be like $30 million or it might be like $130 million. Our whole assessment is to be based on the fact that if this impairment loss has been correctly calculated or not. Make sense? It says that Jobon company deducted the lease liabilities when calculating the net carrying amount of the CGUs for impairment purposes. And let me clarify this to you. You see, whenever you are performing impairment testing on a CGU, you are required to prepare 3 columns, right? Carrying value, impairment, and recoverable amount. Make sense? And in this carrying value area, you write all the assets or liabilities of that cash generating unit. Now, in the case of these retail stores, the carrying value of your assets could include RUA or fixtures and fittings or other assets. And while you are accounting for these assets as part of your CGU, obviously you also need to account for the corresponding lease liability. Does that not make sense? I mean, while you say that your RUA is part of your retail outlet's cash generating unit, this FLO is also a consequent part of the RUA itself. Do you guys understand? So according to IS 36, an entity should consider liabilities as part of their cash generating unit whenever they know that any buyer that would come to acquire this CGU would also assume the liabilities, That is, the liabilities are closely connected with the asset themselves. Do you guys understand? I mean, you have a CGU. What if you were to sell this retail outlet? I mean, you can sell your fixtures and fittings, you can sell your other, central assets. Can you sell the lease? I mean, if you sell the lease, then you can only sell the lease if the other party also assumes the liability of the lease. RUA itself is nothing. RUA is attached to the FLO. And that is why, according to IS 36, you should consider connected liabilities as part of your CGU as well. Does everybody understand this? Isn't this, common sense? Is it fine? All right. And that is what actually the company did. This is exactly what the company did. Jobon company deducted the lease liabilities when calculating the net carrying amount of the CGU for impairment purposes. You guys let me know, everybody let me know, has Jobon company done anything wrong here? Is it right or wrong? Give me a yes or a no. Yes for right and no for wrong. I mean, I don't find any issue here. Is that understood by everyone? Make sense? Guys, if you understand this, just respond me very quickly. Would you agree with the fact that if FLO, the obligation, the liability, is being considered as part of the carrying value of CGU, then this liability should also be considered as part of your recoverable amount? Does that make sense to you? I mean, in order to make the comparison like with like, if you are considering liabilities as part of the net carrying value of the CGU, should you not be considering this liability also as part of your recoverable amount? Doesn't that make sense? I mean, it's common sense. If somebody of you decides that, sir, no, the liability should only be part of the carrying value but should not be part of a recoverable amount, then you're mistaken. Then you're absolutely mistaken, because then the comparison would not be like with like. You just imagine that if you do not consider this liability as part of your recoverable amount, then certainly if you haven't selected anything which is to be subtracted as per the value of your recoverable amount, your recoverable amount would come higher. And if your recoverable amount would be higher than what it should be, you would be missing out on impairment charge. Because impairment is only set to arise when your carrying value exceeds your recoverable amount. If you have subtracted FLO from here and your carrying value goes down, but your recoverable amount is high, then obviously there will be no or very less impairment. This can be a means to avoid impairment. Do you all agree? Do you all agree? Give me a yes or a no, and I want an answer from everyone. Just 2 or 3 guys, I don't care. I want an answer from everybody who's there. Make sense? Right. Now, I want you to read with me. Jobon company assessed value in use to be the recoverable amount. So what they are trying to say is that value in use is the only parameter relevant here. All right. Instead of deducting the lease liabilities from value in use, Jobon company included the contractual lease payments within the future estimated net cash flows of the CGU. So what they are basically trying to say is that they have not deducted the lease liability. They have not deducted the lease liability from the determination of value in use. Is that correct? Is that correct? Is that correct? Is it right not to exclude? Please listen to me very carefully. Is it right that instead of deducting the lease liability from value in use, you only include contractual lease payments within your cash flows? Is it the right thing to do? I would certainly say not, because there is a fundamental blunder here. You see, it seems like that the entity has done everything wrong. You see, I'll tell you what is the correct pattern, and what most likely, what we infer from the question, what your examiner has done. The correct format should be that you should calculate present value of future cash flows. Listen to me very carefully, because this is a very important logic that I'm trying to give. You see, value in use is always the present value of future cash flows. So the correct pattern to include the lease liability should have been that you consider present value of future cash flows and then simply deduct the carrying value of lease liability from here, right? And when you deduct the carrying value of lease liability from here, you will get the net value in use, which you use for the purpose of recoverable amount and onwards impairment testing. Now, what your examiner has done is, examiner, in order to determine value in use, examiner has calculated present value of net cash flows. And while determining present value of net cash flows, they have considered, please focus here, they have considered contractual lease payments. They have considered contractual lease payments within the net cash flow working of value in use. Now, I ask you, is there a difference between these two types of calculations? Is there a difference between these two types of calculation? There is certainly a difference between these two types of calculation. You see, there are 2 points that I'll try to make, and I want you to understand this very conceptually, where this whole scenario went wrong. You see, it can be argued that, sir, rather than first calculating present value of future cash flows and then deducting a lease liability to calculate net value in use, the examiner followed a more simple strategy and simply determined net cash flows. Rather than determining cash flows, they determined net cash flows. And what they duly did, they excluded the contractual lease payments while determining the net cash flows. And sir, we think that this is one and the same thing. Guys, this is not one and the same thing. You see, the contractual lease payments, the so to say contractual lease payments, may not be equal to the carrying value of lease liability. This is not the same. You see, lease liability is recognized based on present value of minimum lease payments. I want you guys to please focus towards me. Please try to understand. The lease liability that would have been recognized in your financial statements, that would represent the present value of minimum lease payments. Make sense? When you have already calculated the present value of minimum lease payments, it does not include the effect of interest in that, because you have calculated present value now. So that means it does not have the impact of interest payments in it. Do you all agree? On the other hand, if you have considered contractual lease payments as part of your net cash flow working, you have considered contractual lease payments in accordance with the lease. And contractual lease rentals also include the impact of interest. Guys, don't you remember? Don't you remember that we used to prepare LAS? Remember, there was a column of date, then there was a column of rentals. I always used to tell you that included within rentals is some part of interest and some part of principal repayment, that is amounts which is besides the interest. Do you all remember? It does make a difference when you, rather than deducting carrying value of lease liability, you have considered contractual lease payments while determining present value of net cash flows. I mean, what I'm trying to say is that these two sorts of working are not the same. Do you guys understand this? Guys, I need your feedback. I need feedback from everyone. First of all, do you understand that these two workings are not the same? These two workings are not the same. I want an answer from everyone. Contractual lease payments means the rentals that are to be paid in accordance with the lease contract. And the absolute amount of rentals that were supposed to be paid as part of the lease contract would also include interest element in it. While the carrying value of lease liability that is solely reported in our financial statements is the present value of minimum lease payments, and it does not include the interest element in it because it's present value. So these two workings are not same, not same, not same, not same, not same. Sir, understood that these two sorts of working are not same. You are saying that this should have been the working, whereas your examiner has considered contractual lease payments as part of the net cash flows. But sir, why does it even matter? Why are you discussing it so much? My dears, it does matter. Just think about it. Just think about it. Let me go back. Just think about it. If I were to take carrying value of the lease liability in my carrying value column and take contractual lease payments, contractual lease payments within the recoverable amount column, would this be a like with like comparison? Would this be a like with like comparison? Why do I say that the correct accounting treatment should have been that the entity should have determined present value of future cash flows and then only considered carrying value of lease liability? Why do I say that? Because then it would have been a like with like comparison. In the carrying value column, you have carrying value of lease liability. In the recoverable amount, you have carrying value of lease liability. If both areas are same, then only you can make a like with like comparison. If you compare a lease liability with interest with a lease liability without interest, it will never match. It is not a like with like comparison. Do you all agree with this or not? I want an answer from everyone and then only I can move forward. Do you understand this point? So sometimes how you actually make sense of the question is that you try to, you know, just try not to read the question very fast. I'm very sure, anybody could have read the question very fast and, you would have not understood the concept, what your examiner is trying to say. All in all, can we conclude that the value in use that has been used to calculate this $50 million impairment is not correctly calculated? And one of our findings is that examiner has considered, the entity Jobon company rather has considered contractual lease payments, whereas they should have considered only the carrying value of lease liabilities as part of their working of value in use. Are all of you guys are on the same page with me? Give me a yes again. I'm sorry I asked for so much yeses, but that is how I know that you guys are on the right track. Make sense? Very good. Now let's move forward. It says that the future estimated net cash flows used to calculate value in use were determined using internal management forecast covering the next 10 years. Do you find anything surprising here? Do you find anything surprising here, guys? Do you remember the rules, the guidance that was provided by IS 36 for the determination of value in use? It must be, most recent forecast. It must be management's best estimate. Do not use, the period should be 5 years unless a longer period can be justified. And here you can see that they are using the next 10 years, as the basis for determining present value of cash flows. And this does not even make sense. I mean, their revenue has halved due to the drop of sales. I mean, if your sales are going down, how can you make a 10-year forecast? How can you make a 10-year forecast? I mean, just imagine if I ask you, what will you be in the next year? What will you be in the next 5 years, let's say? I mean, you can answer. If I ask you, what will you be in the next 10 years, or let's say next 20 years, can you answer? It's basic human psyche that best case, what you can see in future, you can see 5 years ahead, but you cannot see 10 years ahead. You cannot see 20 years ahead. So why has Jobon company considered 10 years, whereas IS 36 required 5 years? Why? Most likely, why would they have considered 10 years? Any idea? I mean, there must be some logic behind their action, right? What would have been their intention? First of all, it's not allowed under IS 36, that's for sure. But why would they have done it? What would have been their, driving point? Let's take 10 years instead of 5 years. Why? When you consider cash flows of 10 years, the value in use would automatically come as higher. Doesn't that make sense? The Jobon company is very smart. They had to make sure that their impairment losses do not rise. And how they have made it sure? They've made it sure by calculating the value in use based on 10 years rather than 5 years. So for 5 years, the cash flows are less. If the cash flows are less, even their discounted values are less. So the difference between your carrying value and value in use, would be substantial. But if you consider the cash flows of 10 years, then your value in use would be higher. And if your value in use would be higher, there is less difference between carrying value and value in use, and hence there will be less impairment. Do you guys understand? They are very smart people. They are not dumb people. Understood? Another mistake that we have found. Then it further says, please follow me. They say these future estimated net cash flows also included an outflow, a cost of $5 million to install advertising technology in the properties to enhance the CGU's performance. Do you get it what they are trying to do? They must have tried to inflate their cash flows in their 10-year forecast. And how do they justify their increased cash flows in a 10-year forecast? They say that we are going to spend $5 million to install an advertising technology, and through that technology, our retail outlets are going to have more sales. First of all, IAS 36 does not allow this $5 million to be considered as an outflow when you are calculating present value of future cash flows. You see, IAS 36 allows you to consider various type of outflows while you're determining value in use. But any outflow that is necessary for the entity to maintain the current performance of the asset, that outflow can be considered. But if there is some sort of outflow which is rather to enhance the performance of the asset, that outflow should not be considered. That outflow should not be considered. You know why? Because when entities say that we are considering an outflow which will actually enhance our performance of the asset, they will also tend to inflate the future inflows from the asset. Make sense? So it's an attempt to demean or to reduce the impairment charge. And also just use your common sense. It again won't make a like with like comparison. If recoverable amount has been calculated based on value in use, which is based on an asset with enhanced performance, you cannot compare an asset's recoverable amount with enhanced performance with the carrying value of your existing asset. It will not make a like with like comparison. And that is why IAS 36 prohibits the use of any outflow or inflow that would be as a result of an enhancement in the current performance of the asset. Does that make sense to you? I want an answer from everyone. Does that make sense to you? So at the very least, we have identified 3 points. We have identified 3 points that we see that, that are against the calculation of value in use. Number one, first of all, the value in use did not include the carrying value of lease liability, rather included the contractual lease payments, and that would not make the comparison like with like. Number two, they considered a 10-year forecast against IAS 36 requirement of considering 5-year forecast. This may have been an attempt to reduce the impairment charge. Number three, they have considered an outflow that would enhance the performance of the asset, which is not allowed under IAS 36, because that would allow the entity to inflate its future cash flows based on the argument that there will be enhanced performance from the asset. Again, this would not make a like with like comparison with the asset's current carrying value. All right. I hope everything is understood. Make sense? Moving on. It says that the future estimated net cash flows were discounted at 5%. This is the weighted average cost of capital of another company in the retail sector, which purchased rather than leased its commercial properties. What have you tried to done? You know what the entity, what Jobon company has done? Jobon company has discounted their present value of cash flows on a discount rate which is of another entity in the retail sector, which is a whack of another entity in the retail sector. And that too is for such an entity which does not lease their asset, but rather invest their own money and buy the retail outlets. Do you think this is a relevant discount rate? Do you think this is a relevant discount rate? What is the requirement of IAS 36 regarding discount rates? What is the requirement? IAS 36 says that an entity should adopt for such a discount rate which includes the current market assessment of the prevailing time value, which includes the impact of current market assessment of the time value and the risks associated with the asset. Associated with the asset. What do you mean? Whenever you determine a discount rate for the purpose of discounting your future cash flows for the purpose of calculating value in use, you always take such a discount rate which reflects the risk associated with your asset, not somebody, some other entity. And examiner says that the interest rate implicit in the lease was 4%. So what discount rate you should have used? If you already have got a 4% rate, which is an implicit rate of the lease, doesn't that represent better the risk associated with the CGU? I mean, why would you take 5% of another entity's WACC, and that entity does not have the same business risk as ours? Does that make sense? That does not make sense. So this is what your examiner wanted you to answer. Let us go back to the requirement. Your examiner asked you, explain why the cash generating unit should have been tested for impairment. Why? So how do you make an answer? How do you make an answer, or what points you consider while answering? Can you give me any points, by the way? What points do you consider when answering? Point number 1, when to perform impairment testing, the requirements of IAS 36 you mentioned. Remember now, whenever we write an answer, we always follow the format according to IAS 36. So first you mention the requirement of IAS 36, when to perform an impairment test. And why was it correct to perform an impairment test? Internal hint. What was the internal hint? Revenue was halved. By the way, there was an external hint as well. What was the external hint? The rise in online shopping. Yeah. These hints would have triggered impairment testing. Do you guys all agree? Do you guys agree with this answer? These are the things that you should have mentioned. Now, like always, I have written an answer myself for you guys, and this is according to the exact format and according to whatever we study in our classes, right? So first of all, I mentioned that according to IAS 36, an impairment review should be conducted whenever there is an indication, hint that the carrying value of assets would exceed the recoverable amount. Recoverable amount is the maximum economic benefits that can be recovered from an asset. It is considered higher of fair value less cost to sell and value in use. Under IAS 36, blah, 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 blah. Everything that we discussed during our lecture, I have written. In this particular case, it is evident that revenue from retail stores operated by Jobon company has halved due to trend of online shopping. Therefore, there is enough indication that idleness and the loss of potential economic benefits would have affected, and therefore impairment testing should have been duly performed. Do you guys understand? I mean, this is a sort of an answer that everybody could have written. Not just me. I mean, you guys could have written much, much, much better than what I have written. Make sense? All right. So a benchmark answer has already been provided to you, and I will provide it to you, obviously. Now, let's go to the second part of part number 8. Discuss whether the method used to calculate the value in use and discount rates are acceptable. Are they acceptable? So under value in use, we determined that the calculation pattern of value in use is rather unacceptable, and there were some reasons for it. The first reason was the carrying value of lease liability was not correctly deducted. Make sense? Was not correctly deducted. Then examiner or Jobon company incorrectly used 10-year forecast, and you would write why this is wrong. 10-year forecast against the allowed threshold of 5 years. And what was one other error that they did? Yeah, cost to enhance the performance of asset. Cost to enhance the performance of asset, which is not allowed. And it's all common sense. I mean, you just need to know the accounting standard, study a bit, and then use your common sense. Is it fine? What about the discount rate? Discount rate. The discount rate of 5% is totally irrelevant, if I would say, because it does not reflect the risk associated with the asset. Yeah. Rather, the correct pattern should have been the use of 4%, which is the IRR. And that would correctly represent the risk associated with your retail outlets, your CGU. Make sense? Is everybody on the same page? Understood? Guys, fine? Now, you see, my intention from these live sessions is that I don't intend to, provide you a lot of rote learning in these live sessions. I mean, this is not the objective. What I'm trying to inculcate within your mindset is that you should sometimes, when you're attempting a question, you should think from common sense. You see, having corporate reporting knowledge is a skill. And once you have got that skill, you need to utilize that skill appropriately into different business circumstances. Yeah. So that's the whole idea. So with that intent, let us read the second requirement and then we'll go towards the exhibit number 2. It says that using exhibit number 2 only, so do not go towards exhibit number 3. Using exhibit number 2 only, discuss whether tiled company should have been classified as a disposal group held for sale and its results presented as arising from discontinued operations in the consolidated financial statements for both the years 31st December X6 and X7. The first thing that you should note within the requirement is that you need to provide your opinion for both the years 31st December X6 and 31st December X7. So there are two accounting year ends in question. One is this year end 31st December X7 and one is the last year end, which is of 31st December X6. Make sense? Can anybody tell me what exactly would have been tested, would most likely be tested under exhibit number 2? Which IFRS are they referring to? Do we need to wait for anyone or something comes into our mind? Very good. IFRS 5. IFRS 5. Non-current assets held for sale and discontinued operations. Now, why don't we have a quick recap of it? According to IFRS 5, an asset is considered to be as held for sale if the entity decides that the carrying value of the asset or a group of assets and liabilities, disposal group, the carrying value of these assets or liabilities is going to be principally going to be recovered through sale rather than through use. Let's say you have a certain amount of assets in a particular retail outlet, and for that or a subsidiary, for that, if you have decided that we are going to recover the carrying value of these assets through sale and not by using this asset anymore, then it is supposed to be classified as a non-current asset held for sale. But before you even make the classification as held for sale, there were some conditions that had to be met. Does everybody remember what were the conditions? Before you could classify something as held for sale, there were some conditions that had to be met. Just try and remember those conditions under IFRS 5. The first condition would be the asset should be available for immediate sale in its present condition. So we need to assess your intent. We need to assess the intent of the entity, if they are truly willing to sell the asset at this moment in time, because whatever their intention is, that intention should be reflected to within the financial statements towards the investors. So we need to check the management's intent. So is the asset available for immediate sale in its present condition? Number two, the sale must be highly probable. How do you see that if the sale is highly probable? The asset is being actively marketed. The entity is actively looking for a buyer, and the asset is being actively marketed at a price which is reasonable in relation to fair value of the asset. Number five, the asset is or is expected to be sold or is expected to be disposed of within 12 months from the date of classification, within 1 year from the date of classification. You guys must remember that we studied that although there is a 12-month period requirement, however, there is a possibility that the asset is not eventually sold within the span of 12 months, but it can continue to be classified as held for sale if the reasons if the reasons which cause the delay in disposal are beyond entity's control and the held for sale requirement is still met. Make sense? And the last condition was that there are, the actions that have been taken by the entity suggest that there are less chances of the plan being significantly changed or withdrawn. Do you guys all agree? All right. And not only guys, in this particular exhibit, disposal group held for sale is being put into question. The examiner has also indicated something about discontinued operations. Do you guys remember about discontinued operations that we studied under IFRS 5? Now what happens when there is a discontinued operation? Your P&L is segregated into two parts: continuing operations and discontinued operations. You do remember that, right? So according to IFRS 5, a discontinued operation is a component of an entity that is expected to be sold, and it represents a separate line of business or separate geographical area of operations, or is part of a single coordinated plan to dispose of separate lines of business or geographical areas or of operation, or is a subsidiary which has been acquired with an exclusive view to resale. Any of the conditions, if they are met, then you classify it as a discontinued operation. I hope now you remember IFRS 5. You must have had a good revision. Make sense? So now we need to discuss whether Tilde company should have been classified as held for sale and discontinued operation within two financial statements, X6 and X7. Make sense? Now with this intent, you go and read the second exhibit. It says that in the consolidated financial statements for the years ended 31st December X6 and X7, both, Jobon company classified a wholly owned subsidiary, Tilde company, as a disposal group held for sale. So guys, please get things into order. First of all, there are two financial statements into question, X6 and X7. Right now, in both, in the financial statements of both years, you have classified your subsidiary as a disposal group held for sale in both years. Now, there are very less likely chances that a disposal group can be classified as held for sale within two financial periods, because there is a requirement that the sale should have been done within 12 months from the date of classification. So we need to be very vigilant whether this classification is correct or not. Examiner says Tilde company's results were also presented as arising from discontinued operations in the consolidated statement of profit or loss for both years. Tilde company is a geographically distinct component of the Jobon group. Just let me know if this thing, if this line triggers anything in your mind, Tilde Company is a geographically distinct component of Jobon Group. Does this ring bells into your mind? What do you understand with this? If Tilde Company is a geographically distinct component of the entire group, then certainly if it meets the held for sale criteria, then it certainly can be classified as a discontinued operation. Because remember, under IFRS 5, not everything is a discontinued operation. Maybe you are just selling a pen. You're trying to dispose of a pen. Now, this pen is not a separate line of business or separate geographical area of operation, or it is not as part of a single coordinated plan, or it's not a subsidiary with an exclusive view to resale, acquired with an exclusive view to resale. So if the entity decides to dispose of this pen, it is not deemed as a discontinued operation, and therefore no distinct classification is done in P&L. But if it's a separate component of an entity, then even the P&L is segregated into two parts. Even the earnings per share is calculated into two parts, separately for continuing operations and separately for discontinuing operations. I hope you understand this point, right? So with this fact that Tilde Company is a geographically distinct component of Jobon Group, discontinued operations requirement has been met. Now, if held for sale requirement is met, then obviously it will be a discontinued operation as well. If held for sale requirement is not correctly met, then it will also not be a discontinued operation. Is that clear to everyone? Is that clear to everyone? I want an answer from everybody. So many people are attending this session. I don't want an answer from one or two people. Clear? Make sense? Very good. Now, guys, it says that in the jurisdiction, by the way, how are we going to determine if the held for sale criteria is met or not? In both the years, X6 and X7. How are we going to determine that? We see if the held for sale criteria have been met. Make sense? We only have to examine this within the remaining parts of the question. So it says that in the jurisdiction, sales of shareholding in subsidiaries require authorization from shareholders of the parent company. So in whatever jurisdiction you are in, whatever country you are, there is a legal requirement that whenever you are disposing of a subsidiary, the parent company cannot do it on its own. They need to go and ask their own shareholders. Make sense? So on 1st May 20x6, and by the way, let me be very clear, 1st May 20x6, you see, one of the accounting year ends in question is 31st December x6, and your examiner is talking about 1st May x6. So 1st May x6 is definitely before the first accounting year end. So it says that on 1st May x6, which is this date, the shareholders of Jobon Company authorized management to sell all of the shares held in Tilde Company within the next 12 months. So on this date, our shareholders provided us the approval, which was, by the way, required by law as well, right? So our shareholders gave us the approval to sell this thing maximum by, next 12 months, which is 31st March X7. It should be sold by then. Make sense? On 1st May X6, the shareholders of Jobon Company authorized the management to sell the shares held in Tilde Company within the next 12 months. But thereafter, the management would have to ask for further approval to sell the shares. So what they are trying to say is the shareholders gave the approval to management that you can go and sell the Tilde Company, but please make sure to do it within next 12 months. If you are unable to secure a good deal within the next 12 months, then you would have to come back to us again and seek our approval again, and we will provide our approval based on the circumstance that exists after 1 year. So shareholders have demanded, the shareholders have only given you a conditional approval, but it's a clear approval, but it should be done within the next 12 months. All right. It says that at the same time, Jobon Company instructed its agents to sell the shares as soon as possible. They have instructed their agent to sell the shares as soon as possible. That means they are actively looking for a buyer. Actively looking for a buyer. How else you look for a buyer of a company? Actively looking for a buyer. You are not going to go to a supermarket and shout, I am going to sell till. You're not going to do that. Obviously, you're going to talk to your broker, ask them, give them clear instructions, sell this company as soon as possible. And that would clarify your intent. Make sense? At the current market price. So there was a requirement under IFRS 5 that the asset should be marketed at a price which is reasonable in relation to the fair value of the asset. And what they are doing is they have instructed their broker to sell the shares at the current market price. So isn't this reasonable in relation to fair value of the asset? Make sense? Examiner says the shares had not been sold by the year end. Now, the shares had not been sold by the year end, but is the held for sale criteria met at the year end? This is a question. Is held for sale criteria met at the year end? I want an answer from everyone. You see, let us run down the conditions. The asset must be available for immediate sale in its present condition. Can you immediately sell the shares of Tilte company in its present condition? Can you do that? And by the way, you're standing on 31st December X6 and you're thinking about it. Can you immediately sell your shares? Yes. By law, you had to sought approval of your shareholders and they have given you approval. And you have immediately instructed your broker as well. So you have the right to immediately sell off the shares. Then the sale must be highly probable. You should be actively looking for a buyer. We already discussed it. The price should be reasonable in relation to fair value of the asset. Yes. The disposal is expected to be completed within the next 12 months. I think from the date of classification, next 12 months, although this has not happened till the year end, but it is quite possible to happen. And since we have already sought a shareholder's approval, we don't see the plan, we don't see evidence of the plan being significantly changed or withdrawn. I mean, we have sought all legal approvals and all shareholders' approval already. So what would you guys conclude? I want an answer again. What would you guys conclude? Can we classify this as held for sale and discontinued operation within the financial year end of 31st December X6? Yes or no? Yes, there is enough evidence to suggest that the conditions would have been met by 31st December X6. Very good. Excellent. Now let's move forward and study whatever is to follow. It says that on February X7, what do you mean by February X7? Now you are in the next year, by the way. You are in February X7, next year. So in February X7, Jobon company reallocated the online sales division of another subsidiary to Tilte company. As a result, Tilte recruited additional employees and purchased new computer equipment. Remember then that when we were standing on 31st December X6, the accountant had to clarify the management's intention of selling this company. And we correctly did so. We thought that everything suggests that the management has clarity that they want to get out of Tilte's business. They want to sell the shares. But then what you see once the financial statements were completed, what you see next year? You see next year that the management have diverted online sales of one subsidiary to Tilte. Does that not ring bells to you? And furthermore, Tilte has started to hire new people and procure new assets as well. So don't you have doubts with regards to management's intention of selling this asset now? You're in the next year now. You're in X7 now. Don't you think there seems to be a doubt that whether that earlier intention is still applicable or not? Don't you think there is a doubt? I certainly think so. And even if you read more, examiner says that when the shareholder meeting happened on May X7, and you remember May X7, by May X7, the previous approval of shareholder would have lapsed. At the shareholder meeting in May X7, there was no discussion on or further approval of sale of Tilty company. So management did not sought shareholders' approval again. Do you still see management's intention of selling shares of Tilty company? Do you see that intention coming? I mean, by law, you had to seek approval. Shareholders gave you a conditional approval last year. If the intention was still there and the delay was due to any reason which was beyond management's control, then they at least should have sought shareholders' approval, but they did not, which clarifies that there is no intention. And further, they have transferred sales of another subsidiary to them. All of this indicates that the intention is not there. And it also says the updated instructions given to the agents by the directors on 1st May X7 stated that they were authorized to sell the shares in Tilty company if, note this down guys, if the cumulative loss suffered by Tilty company for the year ended 31st December X7 exceeded $20 million. The management has given go ahead to their brokers. They are asking the brokers to sell shares of Tilty company, but not now. Not now. They should sell Tilty company's shares if the cumulative loss for this accounting year exceeds $20 million. Up to $20 million, the brokers are not authorized to sell the shares. After $20 million, they can sell the shares. Do you still see intention being intact or the conditions of held for sale being met? As part of the conditions, the asset must be available for immediate sale in its present condition. The if criteria indicates that the condition for held for sale is no longer met. It's no longer met. So there are multiple things which remind you of this. The shifting of sales from one subsidiary to them, the ignorance of not taking the shareholders' approval, then giving an instruction to an agent which signifies that an immediate sale is not going to happen. And furthermore, Tilty company made quarterly loss of $4.5 million per quarter in X7. So for the first quarter, the loss was $4.5 million. And even if you extrapolate, 4.5 million loss was the loss for the quarter. If you multiply it by 4, the answer would come as 18. And this also signifies that even after extrapolation, the criteria does not seem to be, seem to have been met. And therefore, there is no condition. There is no condition. There is no existence of an immediate sale in the present condition. Make sense? So can we conclude that as far as 31st December X6 is concerned, held for sale and discontinued operations could have been reported, whereas as far as 31st December X7 is concerned, held for sale and discontinued operations could not have been reported. Is everybody clear on the stance? Is everybody clear on the stance? And like always, what I have done for you, I have written an answer just for your sake. Believe you me, just for your sake, I have written an answer so that at least you know if you were there in an exam, how would you write an answer? I'm very sure you can write an answer better than me. I mean, you guys are expert. I presume that. But still, just to provide you a benchmark of the approach that you were to adopt answering this question is as follows. If you see, I just replicated the whole of IFRS 5. If you remember it clearly, you can write most of the points. If you don't remember it clearly, write whatever you remember at that point in time. No need to push yourself. Whatever you remember, just go and write it. Make sense? Then, the same according to pattern that I always follow. Then I bifurcated my answer into two subheadings, one about 31st December X6 and one about 31st December X7. This bifurcation would definitely help me. because the circumstances that existed at 31st December X6 were different, and the circumstances that existed at 31st December X7 were completely different. And my examiner wanted me to answer for both the accounting periods, and that is why I made a subheading. And whatever was discussed during our analysis, whatever was discussed during the analysis, I have just written that here. Can you bifurcate in your exam? Obviously, you should do that. That is why I have done it in my answer. Yeah, it will make the life of your examiner much easier, much easier if you prepare such headings. Nobody is asking you to change the page or something like that. Just make sure that you segregate the question. Could this segregation have been done without the use of subheadings? Obviously, you can do that. I mean, in this particular question, there are no professional marks as such, so you're not going to lose anything. But for the sake of your own clarity, once you bifurcate X6 and X7, it is much easier for you to write an answer. And that is why I did the same. Make sense? Make sense? So coming back to the question, guys, the last part, 8 marks. It says that using Exhibit 3, explain whether receipt of the signed letter on 1st April X8 affects your answer to part B. There is a letter that has been received, not the kind of letter you guys are used to write. We are not talking about those type of letters. Please behave. They have received a letter from someone. An examiner is asking you whether the receipt of that particular letter can affect your answer to part B. So in part B, remember, you answered about 31st December X7. Remember, we concluded that on 31st December X7, held for sale and discontinued operation criteria is not met. Now, examiner is asking that a letter has been received on 1st April X8, subsequent to the reporting date. It is an event after the reporting date. Now, can this signed letter affect your answer to part B? You just have to be very clear on that. And then there is another part to this requirement. Explain whether the deferred tax asset should be recognized in the financial statements for the year ended 31st December X7 or X8. You need to talk about deferred tax assets. So examiner is very smart. Examiner has asked you multiple accounting standards within the same question. And if you guys remember, I always used to tell you that, believe you me, in SBR, just by doing 1 or 2 accounting standards, you can never attempt a past paper, because even one past paper has multiple accounting standards from here, there, everywhere. It is tested in just one question. And this is how real life works. In real life, one day you are not going to do IE 16, and for IE 23, you will have to come the next day. That does not happen. In real life, every accounting standard is there in front of you every day. So you need to be so much conversant enough with IS and IFRS that you can cater multiple accounting standards within one context. Yeah. So let us read the third exhibit. And I want your answer, by the way. If you are not going to support me answering this question, then you can leave. Okay. So on 1st April 2008, after the publication of preliminary results of the group, but before the authorization of consolidated financial statements for issue. Guys, please try to understand what is the scope of IAS 10. The scope of IAS 10 is such that it starts from 31st December X7, which is the reporting date. Any event that occurs between the reporting date till the financial statements are authorized for issue. Anything that happens during this tenure is basically an event which is exposed to IAS 10. Do you guys understand this? Make sense? Now, there is something that happened on 1st April X8. And by the way, examiner has clarified that by that time, it was before the authorization of consolidated financial statements. So this 1st April exit is within the scope of IAS 10, right? It says that Jobon company received a signed letter from a third party company outlining its intention to purchase Tilte company. The transaction price was far below the original price paid by Jobon company due to the significant losses of Tilte company since the year end. So basically, examiner is saying that on 1st April X8, you have received a signed letter of intention from a third party buyer to buy Tilte company. Now, I would like to ask questions from you. First of all, the occurrence or the existence or the happening of this signed letter, is it within the purview of IAS 10, yes or no? First, answer me on that. Is it within the purview of IAS 10, yes or no? I want an answer from everyone. Yeah, very good. So if this date or this event is within the purview of IAS 10, then you need to decide if it is an adjusting event or a non-adjusting event. And I would like to ask you, is it an adjusting event or a non-adjusting event? And while you answer, just read the fact that the sale was agreed to be complete on 1st January X9, which is, after 8 or 9 months, whatever. At 1st April X8, the shareholders approved this sale. Now, even the based on the letter of intent that was received by the third party company, the shareholders have also provided to sell Tilte company. Now, my question is this event an adjusting event or a non-adjusting events for the financial statements to be published or to be authorized for issue for 31st December X7? Is it an adjusting event or a non-adjusting event? I want an answer from everyone. You can give an answer wrong, but at least give an answer. Is this an adjusting event or a non-adjusting event? Few answers I have received. First of all, you need to think in your mind. How do you decide if it's an adjusting event or a non-adjusting event? Adjusting events are all events for which evidence exists that the condition of such an event existed at the year end. And non-adjusting events are those type of events for which there was no evidence available of such things happening on the year end. Now let me ask you a very simple question. A letter of intent was received to us by a third party company, not a connected company, by a third party company on 1st April X8, and they showed the intention to buy Tilte company. But was this letter of intent coming to us, was this expected on the year end or not expected on the year end? Was this expected or not expected? You're saying not expected. Does that not provide you the answer? Now, somebody is saying, sir, it was expected that a letter of intention would come on 1st April X8. No. Guys, we instructed our brokers to only sell the shares of Tilte company if the cumulative losses exceeded $20 million. Don't you guys remember? I mean, had we known that we will receive from a third party, we will receive a letter, okay, we want to buy your Tilte company. If you are willing to sell it, just let us know. So if we knew that a letter was going to come, why would we instruct our broker to even check for a sale? Inshallah, let me know. Use your common sense. Did we know about this letter of intent? Was there any condition even that suggests that a letter of intent was to be received on 1st April? No. Had we known, it would have been very easy. Make sense? So this is certainly, guys, this is certainly a non-adjusting event. Certainly a non-adjusting event. And if this certainly is a non-adjusting event, when do you think this held for sale should be reported? You see, the eventual sale is going to happen on 1st January X9. We have an option to either report this Tilte company as held for sale or discontinued operation based on the updated circumstances. Either we can report this within the year 31st December X7, or we can report it within the year 31st December X8. The sale will eventually happen on 1st January X9. Should we report this as held for sale on X8 financial statement or X7 financial statement? Very good, Tareen. Should we report it within 31st December X7 or X8? For X7, this is a non-adjusting event because conditions, existence of such an event, conditions were not there on the year end. So it's a non-adjusting event. You do not adjust 31st December X7. And that means you are going to report held for sale in the financial statements of 31st December X8. But as Tareem rightfully said, sir, at least we need to provide a disclosure of this material event within the financial statement of 31st December X7. Absolutely correct. Absolutely correct. Make sense? Now, can we write an answer for the first part? Explain whether the receipt of signed letter on 1st April X8 affects your answer to part B. In part B, you talked about 31st December X7. Would this signed letter affect your answer to part B? Give me a yes or a no. Would this letter that arose, that came after the year end, but before the financial statements were authorized, would this affect your 31st December X7's financial statement? Yes or no? No. No. Very good. Excellent. And now the last part of the question. It says, now it's by the way, it's concluded, right? In X7, there is no adjustment for held for sale, and Tilte company is treated as a normal subsidiary. But in X8, we treat it as a held for sale and disposal group. All right. Excuse me. It says that agreed sale of Tilte company will create a tax allowable loss, which can be carried forward to reduce future taxable profits. Is there anything that comes into your mind when we read this line? Anything that comes into your mind? There are some taxable losses that can be carried forward to set it off against future foreseeable profits. Yeah. Yes, according to IAS 12, a deferred tax asset can be booked on unutilized tax losses, but for which there are two conditions. What were the two conditions? There are future probable foreseeable profits, and the tax law allows carry forward and set off. Remember, these two conditions must be simultaneously met if you want to recognize a deferred tax asset now. Make sense? It says that Jobon company has recognized a deferred tax asset in respect of this issue in the financial statements for 31st December X7. The deferred tax asset was calculated by taking the value of Tilte company for tax purposes of 12 million multiplied by the corporate rate of tax 30%. The tax loss was acceptable under the local legislation. Jobon company expected to be able to offset the tax losses against its future taxable profits. Let me ask you a very quick question. Has Jobon company correctly intended or recognized a deferred tax asset? Is the recognition of deferred tax asset correct? I mean, the tax loss is acceptable under local legislation. Jobon company is expected to be able to offset the tax losses against future foreseeable taxable profits. has deferred tax asset been correctly recognized? I want an answer from everyone, guys. Give me a yes or a no. I mean, the conditions of recognition of deferred tax asset are met. Somebody is saying, sir, there is no evidence of future profits. What other evidence you want? Because you see, they are saying that Jobon company will be able to offset the tax loss against future taxable profits. So I think there is enough indication that there will be future taxable profits. Yeah. I mean, there is no indication that suggests that there will be no future taxable profits. They have made this assessment. They have made this assessment. And they believe that they will be able to offset this, and the law allows it. And the law allows it. I want an answer from everybody. Is the recognition of a deferred tax asset correct? I mean, why do you always need to think bad? Can't you write that, okay, that's fine, this is the correct thing to do? I want an answer from everybody. Isn't that the right thing to do? Isn't that the right thing to do? Now, all of you guys say this is the right thing to do. But unfortunately, this is not the right thing to do. Oh no, sir. I agree that the conditions under IAS 12 are met. I have no issues with IAS 12. But you missed out a certain thing when I deliberately read the question too quick. You missed out one thing. It says that Jobon company has recognized a deferred tax asset in its financial statements for the year ended 31st December X7. You see, the sale, or at least the held for sale accounting, will not be done on 31st December X7. Guys, this taxable loss will arise due to the agreed sale of Tilte company. Due to the agreed sale of Tilte company. Just now with me, you concluded that this is a non-adjusting event for the financial statements of 31st December X7 because the letter of intent was received after the year end. If you guys are saying that held for sale classification is not supposed to be done, held for sale classification is not so supposed to be done even after the letter of intent, because this is a non-adjusting event. How can you recognize a deferred tax asset on that event, which you are not even recording in 31st December X7? Do you guys understand? You missed that out. The examiner played very carefully. The examiner provided each and every condition within its right fit. And you must be thinking, yeah, the conditions are met. But the conditions are met, not for X7, but for X8. The accounting treatment that Jobon company has done is incorrect. A deferred tax asset can only be recognized when the sale is happening. The loss will arise on sale. The sale is being recognized in X8. It is only being disclosed in this year's financial statements. If the sale itself is being reported under X8, how can you report a deferred tax asset on that sale in X7? Does that make sense? The sale itself, you say it's a non-adjusting event because the letter of intent came after the reporting period. But now you are saying that the deferred tax asset should be booked in X7. Does that even make sense? Do you guys understand? It's incorrect. It's incorrect. Consequent to the accounting treatment of Tilte company being classified as held for sale in the financial statements of 31st December X8, a deferred tax asset can only be booked in that particular period. In the previous period, it is a non-adjusting event, and consequently, for a non-adjusting event, the deferred tax asset can also not be recognized. Does that make sense? Are we all on the same page? Make sense? So sometimes, people say that during their exam, they say, oh, I did such a good question. I wrote every parts of it. But sometimes, what you do is you miss out on correlating the accounting standard with the case. Many a times people go into their exam and they say, sir, I remembered IFRS 5, I knew all about IS 10, I knew all about IS 36, and I gave such a lengthy answer. I don't know why did I not score well? Most likely you would not have scored well because you would have not, you know, you would have not answered within the context of the question. Here you were right as far as IS 12 was concerned, but you were wrong when you linked it within the context of the question. All right. So you need to be careful while you are answering such questions. And for that, you need to do lots and lots and lots of practice. The sooner you realize that these type of mistakes anybody could do in an exam, the better you will perform in your real examination. Just let me know, is everything clear for you? And now, do you see this question being attemptable or not? I want an answer from everyone. Is it a doable question now? I mean, it was a doable question even before I read this with you, but do you guys understand? Yeah. So very well.